All right, hello traders, Jeff with optionboxer.com, back again with another video. As agreed in my blog post, my first blog post about the covered call spreadsheet, this is going to be video number 2 in a handful of videos and posts on my website at optionboxer.com with some free spreadsheet tracking tools that you can use should you be interested in doing so. But the one we have on the screen today and the one we're going to talk about briefly is the vertical spread tracker and the positive expectancy calculator. And we'll look at all the different features here in short order. But before we get into it, please know that this is not a recommendation for you to buy or sell any security. Make sure you're doing your own research prior to trading, and just make sure you've read the disclaimer at the beginning of this video. So that out of the way, the vertical spread tracker and expectancy calculator. So let's see what all this tracking spreadsheet can do. Admittedly, this first column is not necessary, or it's not hugely necessary, but I just thought maybe you'd want to see the trade number. Again, just like on the covered call spreadsheet, I've done away with the dates. They just kind of became cumbersome at a certain point, and I got tired of tracking them in my own trading, in my own spreadsheets. So I've kind of done away with them here. If you want to add them, none of these calculations are absolute, so you should be able to just add in a new column if you choose to, and it shouldn't mess with any of the calculations. If it does, you can reach out to me, and we can take a look at it and see what needs to be done. But first thing you want to do, just like on that other spreadsheet, right click, copy, create a new sheet, the first cell, just paste it. That way you always have this fresh copy of the spreadsheet available to you in case something does get kind of mixed up or lost in the shuffle, or a formula gets changed accidentally. You always have that right there. Just copy it and paste it over again. You could rename the spreadsheet. In this case, we'll just rename it vertical because I don't have a clever name to put there. And we're going to track all of our vertical spreads. If you watched the covered call spreadsheet video, you'll notice that you had to make a different sheet for every different company you were trading. That isn't the case here, but there are a few things that you need to notice. So let's go through here really quickly. Again, the first column is trade number 1. I should say this. I've only got it set here for 100 trades. Well, very likely you're going to trade more than that. So if you ever get to trade number 81, I would just highlight all of these columns here. Click insert, have it insert new columns, and then just drag. I'm sorry, let's do it another way. So you could do it that way. It's kind of tough. You may have to mess with the formulas here on the total column here, or you could just highlight it, pull it down, then just make sure you click on the formula and make sure it's including everything. But you may have to play with that total column here to make sure it calculates appropriately throughout this whole column. All it's doing is summing up this entire column, and you can look at that on your own. But probably the easiest way to do that would be to insert new columns somewhere in the middle here. That way you didn't have to mess with it, and then just drag the formulas down. But I'll let you figure out what's the best way for you to do that. If you have questions, you can always ask. So the first column here is the quantity. So let's say I was trading, in this instance, I was trading one contract of EEM. Alternatively, it could be 25, it could be 250, it could be 2,500. Whatever you decide you want it to be, it's going to calculate accordingly. We'll leave it at 1 for now. And then the ticker symbol, EEM, and then you see I've got some hypothetical trades already entered in here. One of the caveats, and maybe I'm different in this. I think maybe I am because I don't see it a lot, in other spreadsheets. But I always enter my buying trades if I'm gonna, if it's gonna be a debit, I like to enter that with a negative sign. I just see that as, I had to pay money to get something. So yeah, I realize that it's technically an asset, I guess, if you looked at a balance sheet. But I say I'm buying it, so it's negative. It's money coming out of my pocket, and then when I'm selling it, I'm getting money back into my pocket. So that's the way I track it. Maybe I'm weird in that, but that's how I do it. And it's important that you do it the same way if you're going to use this spreadsheet, so that the calculations add and subtract appropriately. So that's the entry, and then the exit. Of course, once you put the trade on, you won't know the exit until you close the trade. But when you look over here, you'll have an idea of where you want your exit to be. And then, of course, it's going to just calculate the net profit and loss from that. Your cash flow is going to take your account starting balance, and then it's just going to add any profits or subtract any losses as you enter trades here. And then the max risk is kind of added for a compounding feature, so to speak. It just kind of helps keep you on track if you want to grow a small account into a larger account as quickly as possible. Otherwise, you may get distracted by just trading or things in your life or that kind of stuff, and it may just kind of get you derailed from your plan of taking this 2,000 in this case and growing it into something larger. So over here on the right, you've got your round trip commissions. Your starting capital in this, like I said, in this case it's 2,000. Yours may be 10,000, maybe 100,000, whatever it may be. The maximum risk, I've got it set at 5%. Although that's probably a bit aggressive, you may want to lower that down to 1 to 2%, but feel free to do whatever you're okay with. And then you'll see the total commissions here. That's just for your own reference. It's going to calculate based on the number of contracts, and then it's going to calculate for your total round trip commission cost there. It will also calculate, it'll add up all your profits and losses and give you a current account value. It's going to use that current account value versus your maximum risk to tell you per trade what your maximum risk will be. So in this instance, at this time, after placing these trades, given my current account value, I can take on a maximum risk of $196.50, or you'll see it's rounded up to 197 there. And then moving right along, the win percentage in this hypothetical portfolio of trades, I have a 63% win rate and a 36% loss rate. In my back testing, it looks like if you can maintain around a 55% win target, you're going to see a growth to your portfolio over time. And 55% may sound, may not sound all that conservative. It may sound kind of aggressive. But when you're consistently setting up trades that are, have a 70% probability of profit, 55% in that light's not all that aggressive. But this is a theoretical number here, and obviously these will be your real world results. So sometimes theory and real world don't always equate. So that's why I put it there, so you could always kind of stay on top of it. The credit in this case, I just added $75. This again just a hypothetical trade. You would use this short vertical expectancy option calculator prior to placing the trade, just to make sure you're in the right spot. Let's say you wanted to place this trade, but the probability of profit was only 49%. Well, you're probably going to want to avoid that trade because in this fictitious example, if you extrapolate that out over 10 trades, you're only going to make $367.50. But if you trade that through 10 trades, you're going to lose $382. And the way that's calculated is it's basically taken. It's given you a 49% or 4.9 occurrences out of 10 that this becomes profitable, and that's going to give you your theoretical gain on 10 trades. And then it's going to say the inverse of 4.9, which would be 5.1, would be your theoretical loss. So you want to make sure you're trading above 50%. I like about 60 to 70%. And then that way you can see the theoretical gain is considerably higher. And then the stop loss to break even, that is basically just kind of a number to highlight. If you wanted to protect your account, now, trading vertical spreads, it could be argued that the best scenario is they're a defined risk trade. So if you're going to set one up, it could be argued that you just leave it on. Let whatever happens happen. I mean, at some point you made the assumption that the market would move whatever direction you set the trade up in favor of. And so it's certainly an argument there to just let the trade do what it's going to do. I can't tell you how many times in my own trading I've had a trade that goes against me and then would have closed out for a maximum profit at the end of the day. So there's certainly a debate to be had there. But if you did want to set a stop loss, you could set it at 112.50, and if you did lose 4 of these trades in this instance, 60% is theoretically telling you you're going to win 6 out of 10 trades, and it's telling you you're going to lose 4 out of 10. So if you wanted to protect and you wanted to make sure you were at the very least going to break even, you would set your stop loss at $112.50. And then the long vertical expectancy calculator, I mean, admittedly, I had to work with this thing nonstop, so the calculation here may be a little bit off. But it's similar in nature. It's just worked a little bit, well, it's worked backwards. So you're going to take your max profit. Let's say you wanted to do a dollar wide, dollar strike width, long vertical spread. And it was going to cost you $40 to purchase it. Well, odds are that's going to be an out of the money spread. So we'll just leave it at 45%, and then that would be your max profit would be 60. And so you can see your theoretical gain over 10 trades would be 270 at this particular probability. And then the theoretical loss would be 330. So that wouldn't be a trade you'd want to take. You'd want to keep this around 70% as well. But keep in mind that the higher percentage probability of profit or probability in the money, the more it's going to cost you, the higher debit it's going to cost you. So that means the lower the maximum profit would be. And then the max debit, it's telling you what the most you should pay for this spread is. And again, honestly, I don't know how much I trust this number. So just be careful with the long vertical expectancy calculator. So that's about it for the spreadsheet and the expectancy calculator. I guess the one last thing, we talked briefly about the max risk, and the reason I really like this is if you trade consistently with 60%, let's say, short credit spreads, and you're always in a positively expectant trade over time, whether it be 10 trades, whether it be 100, whether it be 10,000, over time you're going to be profitable. And if you're profitable over time and you're consistently compounding your investment, you're going to turn a small amount into a large amount, and you're going to do it as quickly as you possibly can. The alternative here would be that you maintained the current risk of $100 throughout all of these trades. Yeah, your account may still grow, but you're never taking on any more risk, and therefore your account's growing at the slowest possible rate. So just be mindful of that. Of course, more risk means exactly that. Means more risk of loss, and so you have to make sure it's viable for your own financial situation to trade something in this manner. But in any case, it's free. It's available on the website. There will be a link in the description to this spreadsheet. But if you have any questions, reach me in the comments, or feel free to email me at jeff@optionboxer.com, or reach me on my website at optionboxer.com. All right, guys, thanks for watching. See you next time.